Today we discuss the cost of capital and how that should impact the expected return on stocks and the tax implications of rolling a 401k into an IRA.
This is InvestTalk, independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our May 23rd, 2024 edition. I'm Justin Klein, and I'm here once again to help you navigate through this crazy world that we are living in, this new environment that is challenging for many on both the personal and the financial front. Now, we are here to hopefully help with that financial side by helping you have the right mindset to avoid the pitfalls and take advantage of the opportunities. Now, both of those are different than they were pre-pandemic. The asset classes are moving different, and the subsectors within those asset classes are also acting different. And the broader economy is different as well. Some things are going back to the way they used to be, and some things are not. And so it depends on what industry you're talking about, what company you're talking about, what country you're talking about. And we're here to unpack it all for you. And we do that by answering your finance and investment questions, as well as giving you data and perspective developed over 20 plus years of investment experience. Now, with that said, we're going to dig into the market's performance for today. It was an interesting one, that's for sure. We'll also run down some show topics, but right after we answer our first caller question now.
Hello, I was wondering if there is any difference between a high-yield savings account or a money market fund for having extra cash deposited. Thank you.
Well, as long as they're both under the FDIC limit, and sometimes money markets fall under a different purview, but as long as they are government-backed, there's really no difference in the safety. Then it's just yield and ease of getting your money in and out. If it's at your bank, obviously that's pretty easy. You just go in your online platform, move the money to your checking account, and you can go spend it. Whereas if it's at a different firm, you might have to go and make a transaction. You might get that in a day or two. Maybe that difference matters to you. Maybe it doesn't. Okay, but the simple answer is no. There's really not much of a difference besides that yield that you're going to get, and obviously you want to try to get the better yield that you can. All right. Now, we have a lot of ground to cover over the next 45 minutes, and our main focus point is about the cost of capital and the reality check on high-flying stocks and why you shouldn't bank on those big returns. So we'll look at how cycles can move, both for you and against you, and there's recent memory to give you some examples. And we will dig into that story and how to apply that to your particular situation. In addition, a few other topics. One is the positioning in the metals market, not just gold and silver, but also what we call base metals. So copper and the like. So we're going to dig into the details there. Also, giving a loan to your family, how to make sure you are structuring it correctly. You can't just transfer money and say it's a loan and think everything is going to work out. You have to kind of structure it properly, especially if you may forgive it at some point. So we'll look at that. And then lastly, Canada. For years, decades really, Canada's oil industry has been reliant on the U.S. market, but they are expanding their pipelines. So we'll talk about what that might mean for the Canadian oil producers. We also have voice bank questions. One is in regards to transferring money from a 401k to an IRA, and then UPS, United Parcel Services. We also have questions submitted in the comment section via our YouTube channel. So we'll look at those as well. And of course, I welcome your finance and investment questions right now at 888-99-CHART. Now let's take a look at the market today. It was a decidedly negative day overall. Markets certainly pulled back. The small caps did the worst, down about 1.46%. NVIDIA had earnings, good earnings, and it was up about 9% on those earnings. We'll see if it can hold. Usually what I say is around big news, like earnings, the market kind of settles out after about 3 days. Then those stocks tend to react normal again. But until then, a lot of it's positioning. People are still digesting that report in the news and figuring out whether they want to buy or hold or sell. And so it'll be interesting to see if that holds. But, the broader market definitely sold off throughout the day. You had Intel down 4%, Tesla down about 3.5%, AMC, part of the meme stock craze, that was down over 10% there. NIO, the Chinese car maker, down 8.4%. AMD was down 3%, so not in sympathy with NVIDIA. Let's see, what else was moving? Cytokinetics, one of our InvestTalk Market Madness contestants, that was down 17% today. Solar Edge, down 10%, so the solar industry certainly taking it on the chin. And what you see is interest rates went up. So decent move higher on interest rates. And that was interesting, right? That the market sold off. There's correlation there between stocks and bonds. They're not inversely correlated as neatly and nicely as they used to be. And so a sell-off in the bond market can certainly create problems in the equity markets as well. Overall, I think we are entering a choppier period. We had a nice start to the year. It was pretty much straight up. It's been pretty much straight up since the end of October after the market pulled back, and that was due to liquidity. But liquidity over the next, call it 4 months, likely to get a bit tighter. Now, not as tight as you saw in the summer of last year. So, is the pullback going to be quite as large? Probably not. But, the S&P closed today down 39 points to 52.67. Could we get below the April lows? Absolutely. Could we go all the way to, say, 4,800 or so on the S&P? I think that's certainly possible as well. That would only be roughly a 10% pullback in markets. And remember this. 10% pullbacks are normal. They're average. They're garden variety drops in the markets. Most years have a 10% pullback or more. So we haven't had one, obviously, because of that very bullish start to the year. So could we, in the summer months, which tend to be a bit choppier, could that be a time period where you get a bit more volatility? I think that's certainly possible. And guess what? We're very close to June and summer is approaching. So that's kind of where we're at. And, don't think you sell everything, go to a ton of cash or anything like that. But this is where you start to sharpen up your pencil, look at the positions that you have, maybe rebalance a little bit, and recheck your buy list and say, okay, which names should still be there, are still performing from a business perspective in the right way. And if they do drop to a certain level over the summer, that I pick them up. And that's probably what you should be doing right now. Now, we're heading into a short break. On the other side, I will tackle your finance and investment questions, some that were recorded on our 24/7 voice bank, and others that were let in via the comment section of our YouTube channel. And please remember that you can call anytime and leave your questions on the InvestTalk voice bank. The number is always 888-99-CHART.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions.
Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors.
Hey guys, I had a question about UPS. Today they had a news release that they issued some debt. And according to my brokerage account where I get my information, it says it was yielding around 1.05%. And just looking to see how you'd interpret this. Is this like a big deal, not a big deal? I plan on holding it for the long term. I personally didn't think it sounded like a big deal, but the market seemed to not like that, because as soon as that was released is when the stock actually took a little tumble today, just 1%. But yeah, if you could just explain how much that actually is for this big company, and your thoughts on the company as a whole. I'll listen on the show, and I appreciate your help. Thanks. Bye.
Yes, this is UPS, and it was down today, closer to the lowest levels on the year, and it did issue different notes in different maturities, 10 years, 30 years, and 40 years. And you read this a bit wrong, okay? And what it is the spread above treasuries, okay? So, for example, the $600 million note will on the 40-year bonds will yield 1.05% above treasuries, okay? So that might be that's probably a spread, a floating rate loan, and maybe the market didn't like that because it's floating rate, and they don't want to have to worry about that, right? About rates going up and the cost of capital for UPS going up. So that's probably what the market didn't like, but that's not the yield that they're paying. They're paying more than that. They're paying, there's usually a proxy. I don't know what proxy they're using. I have to dig into this again. I haven't looked at it in a second, but definitely something that you shouldn't be too worried about. UPS is a strong balance sheet. They're just refinancing some debt and restructuring their balance sheet, but not in a way that should worry anybody. So I wouldn't interpret it bearishly, even though the market did dip on the news. Thanks for the call. Now, you probably noticed that we were answering questions submitted via the comment section on our YouTube channel. And this one came in from Carter Erickson, looking at NDSN, Nordson Corporation. And this is a name that we bought a while ago. They did recently have earnings, and they are down on earnings, but we really love the business. We love the consistency of the business and the fact that they are extremely profitable. Now, once again, the market didn't love the earnings, but the long-term growth trajectory remains fairly solid. Now, what are they? They manufacture equipment used for dispensing adhesives, coatings, sealants, etc. And so one reason we love it is because it has diverse end markets from packaging, medical products, electronics, industrial, etc. And it's about a $13 billion market cap, so mid-cap name. So it has nice heft to it. And it's extremely profitable. Return on equity around 18%, 18.3%. Long-term average around 21%. And, we're big fans of the business. Very clean balance sheet. And so on this dip, I think it's definitely a buying opportunity. And we really like it because as companies reshore manufacturing, they're going to need to buy equipment that Nordson, helps produce. So that was Nordson. NDSN is the symbol. Thanks for the comment. Now, as we go to a break, I want to remind you that the InvestTalk Wealth Webinar, hosted by myself and Luke, is coming up in just a few weeks, June 11th, and it's titled Quality Investing, Digging Deeper Than Dividends. And it's all new, it's free, and you will gain valuable insights into how to avoid value traps, for example, and really identify those true opportunities, not just the ones that pay a big dividend, but that have quality behind their name, quality behind their business. And it all happens online. Once again, June 11th from 1 to 2 p.m. Pacific time. And you can register right now for free by heading over to investtalk.com. And now, the phone lines are open, waiting for your call at 888-99-CHART.
You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
chart 888-992-4278 is how you get through and ask your question on today's show. And our main focus point is about the cost of capital. And companies issue equity and debt. Those are the two main ways companies finance themselves. And there's a cost to this. And a lot of people just think of debt as a cost, but equity is a cost as well, because that is ownership of part of the business. And if the business doesn't own, all of the shares, control all of the shares, they are subject to votes from shareholders. And so there's a cost to that equity. Now, when you look at the cost of capital, that typically drives expected returns going forward, typically. And that's why when you are looking to invest, you can't just look at the recent returns. You have to look at what's the cost for them the businesses to finance themselves if they were to raise capital. Because that, once again, tends to align more long-term with the expected returns of equities. Now, long-term returns on equities are about 10% annualized. That's in nominal terms. Okay, that's not backing out the inflation rate as well as the cost of investing. A cost can be a little, that cost can be a lot. Now, academic research suggests that returns can be boosted, however, by emphasizing a few things. So one are style factors. So think of large cap versus small cap. Long term, small caps do better. Talking extended period of times. Obviously, any given decade, you can have large caps outperform, but long term, small caps do outperform. Why? Because they tend to have higher costs of capital. Okay, so that's one style factor to weight. And that's why equal weight indices tend to outperform, because they give equal weight to both the biggest companies in the index as well as the smallest company in that index. And then there is relative value. So we know that over long periods of time, value tends to outperform. There are only 2 decades where growth typically has outperformed, and that was in the 2010s as well as the 1920s. Those are the 2 decades where there's clear outperformance of growth. Most other decades, depending on what index you're looking at, it can be relatively neutral, and in other decades, value can drastically outperform. But over long periods of time, price matters, valuations do matter. So that's another style factor to consider. And then lastly, profitability. And this kind of hits what we'll be talking about in our webinar coming up in June, which is which companies have the most quality business? Which ones are consistently profitable? Not just a flash in the pan, one-off great years because of idiosyncrasies within their sector or the broader economy. It's about which ones have durable competitive advantages, what we call economic moats. And so that is another filter that you can add on to boost returns above that 10% annually. So it's very important to not color all equities with the same brush and understand over extended period of times what returns you should expect. Because last year, the Mag 7 was up 76%. Now, that was after in 2022, it was down huge, right? I don't have the exact number in front of me, but it was a snapback rally. But should you extrapolate 76% going forward? No, because you know there are years like 2022 that happen. And then there are more middling years. Okay. Now let's grab another question from the InvestTalk YouTube channel. This one came in from Robert Tancredi. What are your thoughts on NVO? NVO, I've had it on my watch list for a while, but I'm concerned about getting into it considering its PE. Now, Novo Nordisk, I believe this is one that's caught up in the GLP-1 craze. And, I think a lot depends on whether or not you feel that is durable. I'm 40, okay? Been around a while. And I have seen so many diet fads, drug fads, etc., and they all flame out. Why? Because over long periods of time, you take enough people take the drug and they realize there's longer term side effects that maybe don't show up in the first month, 2-3 months. And therefore, those diet drugs are only really worth it for a small subset of people. And I think that's going to be the same thing with these GLP-1 drugs. So while Novo Nordisk, I think it's a good company, it's a good business, but as you said, it's trading at very high multiples, and I would not be chasing it up here unless you have firm belief that the current demand for GLP-1 drugs will remain in the same general vicinity of demand over the long term. I personally do not, but that's what makes a market. It's different opinions, so depends on your opinion. Now, on the next Invest Talk, we'll look into this question. Investors are urged to proceed with caution when focusing on yield. Investors selecting funds based on dividend yield should be aware that high yield is no assurance of higher expected returns. We'll dig into that story tomorrow, but for now, I'm Justin Klein. I'm ready to take your calls at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Do you want to take your investment strategy to the next level?
We invite you to visit investtalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to investtalk.com, submit your portfolio, and let us help you on your journey towards greater investment success.
Hey, this is Randy, the truck driver from Iowa. Love the show, have learned a whole lot, although I still know practically nothing. Quick question about a 401k, which may eventually have to go through an accountant, but I thought that with all your experience, you might have come across this and be familiar with it. I'm over 70 and still working because I didn't manage money well, but I'm trying to put it away now. What are the laws, or what is the regulation about transferring money from a 401k, a standard 401k, to a regular IRA? Is there a limit? Do I count that as my IRA contribution for the year, or is that all? How does that work? Thank you.
Very simple. There's no tax consequences. You can roll over as much as you want. You are over the age of 59 and a half, so you should be able to do what is called an in-service rollover. Most plans allow it. You have to check with your HR department, but it allows you to roll your 401k even though you're still working into an IRA. That opens you up to a lot more investment options, and it's usually a better choice for the vast majority of people. Once again, no tax consequences. There's no limit. You can roll over $10 or $10 million. It does not matter. You can also make contributions to that IRA if you qualify. So you can roll over $1 million and make your $7,000, well, you're over 50, so $8,000 a year contribution to that as well, as long as you have earned income. So, it's pretty simple. Go open an IRA. I would encourage you to do it at one of the large brokerage firms. We use Schwab, but Fidelity's good, E-Trade, etc. And then usually the HR department will send a check. Some will send it directly to the broker. We tell our clients, if you can have them send it to the broker, that's faster, that's better. Most of them will want to send it to you first, and then you have to mail it off to the broker or somehow get it deposited. So yeah, that's simple, and no tax consequences as long as it's in a traditional IRA. If it's a Roth IRA, then that counts as a Roth conversion. That's a whole nother story. So make sure it's a traditional IRA. Now let's talk a little bit about metals. Metal prices are booming. Copper and gold are at all-time highs. Copper is up 30% since the start of March, breaking above $11,000 per ton. And gold is also, even though it's pulled back the last couple of days, around 2,400 per troy ounce. Silver broke above 30 recently for the first time in a decade. And what was interesting is last year there was strong demand in that depleted inventories. And what you've seen this year is a surge in demand from investors, from speculators. And that's after many years of commodities falling as a share of the global markets. Today, they're only about 2% of the global markets over the past 12 months, talking about volume of trading and value on the marketplace. And that's down from 8.8% of total global markets in 2009. Okay. What you're seeing now is a boom in open interest from mainly investors. Okay, open interest across base metal and precious metals reached a record high of $227 billion on the metal side and $215 billion on the precious metal side last week. And this is twofold. One is short covering. A lot of this is short covering, and that's because of the lack of supply that's out there of the raw commodity. And so at a certain point, you get a trigger especially when these prices hit all-time highs. You typically get a rush of people that have an out there, and they tend to cover pretty quickly, and that's a big part of it. And there's also a lot of long positions being opened up to take advantage of the future moves. Net long positions on the COMEX and the London Metal Exchange were 2.6 million tons in the middle of May. That's up from only 556,000 tons at the beginning of March. So you're talking about 5x roughly between beginning of March and mid-May. That's the highest level since 2020, late 2020. Now, we know that copper is the most vital to the process of decarbonization, and that has really led the surge here. And I've been saying this for a while now. Everyone's calling about lithium, and I always say, lithium is not the green metal or green material that you are looking to invest in. It's very easy to bring supply on. And all you've seen recently is a little bit of a dip, a decent dip, in the demand for electric cars. There suddenly becomes an oversupply of lithium, and lithium prices have sunk dramatically. Let's look at Albemarle, one of the largest lithium miners out there, peaked at $330 per share back in the fall of 2022. Now it's at $122, so down significantly and just continues to kind of grind lower. Whereas copper companies, many of them are hitting all-time highs, and it's not just copper. Base metals such as zinc, aluminum, and lead have all gone up between 15 and 28% since the start of April. And funds are putting money behind commodities to get this exposure to deglobalization, decarbonization, all the trends that we've been talking about, hedging against inflation, geopolitical risk. All of this is something we've been talking about for pretty much since the start of the pandemic. And you never know when that tide is going to create a breakout, because markets move in kind of step patterns. They move up for a while. They move strong. There's strong returns. There's over zealousness from the investor community. Things get a little bit ahead of themselves. Then you go through a price discovery phase, usually a consolidation phase, before things take that next step. And you've seen that next step higher as well. So there's an inflow to broad basket commodity funds. And so you're seeing rises in prices in grains, minerals, metals, cotton, cacao, etc. And you've seen these inflows double in April year over year. Okay. And there's also been, I think one of the main catalysts too is that consolidation phase was really being held back by a Chinese economy that was slowing, and their exports, their PMI numbers were contracting really for the past 6 months until the last 2 months, when you've had 2 consecutive months to see global manufacturing output in China specifically tick up. Okay. And then you add on top of that, BHP, they're trying to take over BHP was, they were trying to take over Anglo-American. That's what it was, Anglo-American. And what it showed was that the cost to buy a mine is cheaper than going out and doing it themselves. And it just also shows you how cheap these companies still are in general. Some cheaper than others, some have better assets than others. So it's not a kind of one size fits all type of view that you can say, oh, I want to buy all commodity companies. They all look the same. Many of them they're all very different in their jurisdictions and their exposure to different raw materials, et cetera. So you really have to delineate. But it just shows you that this is an environment that is definitely behind a lot of the metal markets, and you're starting to see that show up in spades. Now let's step back into the InvestTalk voice bank for a question that came in earlier from a listener in Alabama.
Good afternoon, InvestTalk. This is Jeff from Alabama. I have a question about the ETF Global X, MLP, and Energy Infrastructure ETF. The symbol is MLPX. I would like to get your opinion on this. This is a ETF that lets you avoid a K1. So I have this in a couple of my portfolios, and I'd just like to get your opinion on this. Thanks very much. I'll be listening on the podcast.
All right, looking at MLPX, and this is a fund that mainly focuses on energy infrastructure. That's the name of it. Global X MLP and Energy Infrastructure ETF. And they do own some MLPs. And for everyone out there, MLP stands for Master Limited Partnership. And the reason that he said it helps you avoid the K1s is when you own an MLP or any limited partnership, you get a K1 at the end of the year. And that becomes, an issue with your tax man, potentially. Depending on your tax bracket, it can be more or less of a problem. And a lot of people want to avoid that. So they buy this, and it prevents you from having to deal with that. Now, this not just owns the MLPs, but it owns other companies in the infrastructure, energy infrastructure world. Your Williams Company is the top holding, followed right behind by ONEOK, and then Enbridge is number 3, TC Energy number 4, Kinder Morgan. That looks like the first master limited partnership. That is 5th on the ranking. 24 different holdings. So decent diversification there. And, if you're looking for broad diversification, you don't want to dig in and do the work on which one is the best. This is not a bad way to go. And allows you to avoid that K1. So I have no problem with it. I like these type of businesses. In fact, we own one of those top 5 for clients and have for some time. And it's one of the most consistent performers, consistent dividends, and we like it. So this is a good broad exposure to that space. Now, 2024 is moving fast, and we are almost through the month of May. And that means, are you understanding the trends in today's market? As we approach the halfway mark in the year, as we approach probably a more choppy period in markets. Are you able to fit your portfolio for these times? We talked about the differences, higher inflation, higher interest rates. all of this matters because it will color the performance of different subsectors and asset classes for a number of years going forward, probably the next couple decades, because we know that the government, they're in a lot of debt. And there's two options. It's either defaults on their debt nominally or inflate away the debt. And history says they will inflate away the debt, which, once again, that brings a different way of thinking about markets. And so if you need help understanding whether your allocation is up to par, up to the level that is needed to survive a market where, you're probably going to see real yields on low yielding securities sometimes dip into negative territory. Meaning, hey, it might yield 5%, but what happens if inflation is 6 or 7%? 5% used to look good. But in an environment where inflation might perk back up to 6 or 7%, suddenly 5% is now a negative real return. That doesn't mean you're going to get that every year. Markets aren't like that. Every year is a little bit different, but you start to average things over long periods of time. You start to see an environment that is different. And just look at the last 3 years. You had the big rally in 2021, then a big sell-off in 2022, rally last year. This year, to start the year, markets have done well, but now we're entering a bit of more choppy period, and that's how markets operate. They have different colors, but it's really about those broader trends. And are you aligned? Well, I encourage you to reach out to myself at our company, KPP Financial, where we practice parallel investing, which means we invest right alongside our clients. And we offer free portfolio review assessments via telephone or GoToMeeting. Just head over to investtalk.com, click on the portfolio review button on the top right-hand part of the screen. Now, let's get into our next focus point, and that is in regards to let's talk a little bit about the Canadian oil pipeline. I think this is very, very interesting. Now, at the start of the Biden administration, they canceled the Keystone XL pipeline, but Canada did not quit. They didn't say, okay, we're just going to take it. We're going to take the discount that typically comes with selling oil into the U.S. market. That's what these Canadian oil companies have had to deal with. They said, we're going to find another way to get our oil to the global markets. And frankly, this is probably a better way. And it's called the Trans Mountain Pipeline. And it started commercial operations on Wednesday. Today, actually. No, today's Thursday. Yesterday. And what it's going to do is move oil from Alberta, where most of the Canadian oil is produced, especially in the oil sands, over to British Columbia and onto the Pacific coast. And it's the most expensive infrastructure project in Canadian history. And it's going to allow the project's going to allow the system, the Canadian pipeline system, to triple its capacity to nearly 900,000 barrels per day. That's more than the Keystone XL pipeline was supposed to carry. Remember, Canada is the world's largest producer by volume. Sorry, not largest, fourth largest producer by volume. And most of the oil right now flows from Alberta's oil sands down to the Gulf Coast and the Midwest to those refineries. But the discount that they have to take is upwards of $50 per barrel because they don't have another place to sell. The Canadian economy is not large enough to sop up all the demand, all that supply of oil. So they have to export it. And it's mainly just been to the U.S. Now, China is buying this oil. Sinopec is one of the first to sign up to buy some. They're going to be able to ship to oil refineries here in California, also Latin America, and even all the way to the Middle East. And the discount on Western Canadian crude has fallen from $19 a barrel at the start of this year to $12 at the end of April. So a lot of the Canadian companies, and this is something to look at, are starting to benefit. And we're actually picking up some of these Canadian names as well. So I think this is an interesting little wrinkle that's happening in the oil markets worldwide, globally, and this is going to bring on more supply to the benefit of many of these Canadian oil companies. Now we're heading into our final break, but I'm ready to take your calls now at 888-99-CHART.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
We're here to answer your finance and investment questions. So make sure you give us a call at 888-99-CHART.
Hi, Justin and Luke. This is Rob calling from Las Vegas. I had a question pertaining to industrials. I've got two positions. Both have different business models, and I wanted to check to see if the industrials are still in favor with you guys. One is Brady Corp, BRC. The other one is Powell, POWL. Both had pretty good runs up this past week, and I just wanted to see if I should maintain these positions or if you see further upside on one or both of them. Thanks for your...
All right, looking at Brady and Powell. Brady is BRC, and they manufacture identification labels, signs, badges, and software. It's definitely overbought. It had good earnings, went from about $60 per share all the way up to about $68 at the close today. So nice move in just a couple of days. I would say this is not a name that I would be quick to trim. It doesn't seem overvalued, good balance sheet. And what I like about it is that it consistently grows its earnings. It's earned $1.84 back in 2017, and it's basically been increasing its earnings every year, except for 2020, which obviously that was COVID, so a little bit of an anomaly. So I like that just consistent earnings trajectory. And once again, it's not really overvalued. Now, Powell is a different beast, shall we say, because that's POWL, and that's also doing very well. But, this has a shoddier history when it comes to its business. They lost money in 2017 and 18. They were profitable in 2019. And then things kind of went awry during the pandemic, understandable. But they remained profitable. But earnings last year was for $4.50 and $9.20 expected this year. And they make power substations. What I like their business. I like what they're in. I just don't like how variable of the profit performance has been over time. And really, this high return on equity, talking high teens or higher, has only happened for 3 quarters. Back in 2013, they had a good string where return equity was in the low teens, but that was kind of a flash in the pan as well. So I would be quicker to sell out of Powell, especially because even if you say they're going to earn $9 per share next year, which that's what's expected, on a $184 stock, it's about 20 times earnings for a company with a history that's all very up and down when it comes to profitability. So I would be quicker to trim, take profits, etc. on Powell over Brady. But both are, the technicals are fine, so you probably don't want to be super quick to take profits. But Powell is the one I'd keep an eye on most of all. Thanks for the call. Now, lastly, let's talk about giving a loan to your family. This is happening a lot, especially the boomers are giving loans to their kids, grandkids to buy a home. And it's perfectly legal, but there are some boxes that you have to check. Okay. Now, the first thing you need to do is be honest with the mortgage provider. If it's a loan for a down payment, you have to tell them what the source is, the terms of the loan of the down payment, and let them resolve any issues. Failing to disclose this type of loan could lead to legal trouble. Okay, so that's number one. Don't try to get around it and play some funky games, okay? And then it's important to show that it's an interfamily loan and specify whether it's a down payment or a mortgage. Put all this in writing and make sure it's an arm's length transaction and it's not disguised as a gift. Both parties should sign it. Should be clear terms. and of when the interest is due, what the interest rate is, and how long the loan is for. Now, it also needs to have a certain interest rate on it. As of April 2024, there's what is called it's called the applicable federal rate determined by the IRS. Applicable federal rate, and in April of this year, it was 4.5%, which is obviously much lower than a normal mortgage. So it's not like it's a huge discount, but it's some discount. And in order to get the write-off for the person borrowing it, it needs to be above that level. So make sure it kind of conforms to all of these rules, and make sure you have it in writing. Now, you can forgive the loan, but it does count towards the gift limit each year. So you'd have to do it in stages, probably. Okay. Well, that does it for InvestTalk. Appreciate you all tuning in. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Now, on June 11th, we are presenting the next new InvestTalk Wealth webinar, Quality Investing Digging Deeper Than Dividends, which you have to register over on investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.